Hello everyone, welcome to the 19th episode of Your Money, Your Taxes. I'm Lalit Abichandani, owner of ABIC CPA Associates. With me today here is Paresh Shah, CEO of Paresh Shah Financial Services. He's a certified financial planner and wealth strategist for the past 17 years, helping individuals and businesses co-create innovative financial strategies. He's a licensed CPA presenter, educating CPAs as they guide their clients on the investments, life, disability, and long-term care insurance. He specializes in pension and profit-sharing plans, asset protection, estate planning, and business succession planning. Pareshji graduated as a chemical engineer from prestigious IIT at Kharagpur. His strong sense of professionalism and community service has kept him alive here in United States as well as in India. He supports healthcare and education initiatives for the financially challenged. Pareshji resides in town of Jericho in Long Island, New York with his wife Shamul and their son Shamik. Shamik is a freshman at Stony Brook University, New York. So Pareshji, today we are going to talk about estate planning, and Pareshji will be educating us about this topic, which in my opinion is very important and a very hot topic these days. So Pareshji, welcome.
Thank you, Lalitji. Thank you for the great introduction.
Okay.
Really appreciate that.
Pareshji, in the last few episodes we talked about the legal documents, the healthcare proxy, the power of attorney, which is part of estate planning. But can you describe a little bit more what really is the estate planning? I know it's more than just these couple of documents.
Yeah. So, we did cover wills, healthcare proxies, and power of attorney in the last episode that we did. But that is just a portion of estate planning. Basically, when we define estate planning, what we are talking about is that we're talking about the event that takes place after a person passes away. And what we want to happen after that, that means all the things that I own or control, who do I want that to be passed on to, at what time, and in what way, so that it is efficient in terms of taxes. That is what estate planning is about. So I own all the things that I own, my home, my assets, my 401k plan, my collectible items, all the things put together. After I am not there, who should it go to? Should it go immediately? Should it go at a later point? All those things need to be covered in estate planning, and it becomes a little broader scope than just the documents of wills, healthcare proxy, and power of attorney.
I agree with you, Pareshji, that basically what you just said, most people know that as a will, but there is more to estate planning than just creating a will. There is a systematic process to it. Can you explain a little bit more in detail?
Yeah, absolutely. So basically, when we are working with clients in their area of financial planning, there are we end up doing what's called life cycle planning. And in life cycle planning, the first stage is accumulation, then the second stage is distribution, that is retirement income planning, and then finally legacy planning. So legacy planning is where estate planning comes in. That means after you, what should happen? When we divide a person's assets, there are three categories of assets that we consider when we are talking about estate planning. So the first category of assets is those which get passed on by beneficiary designation. Example, 401k accounts, IRA accounts, life insurance policies, accounts, bank accounts which are outside of a retirement account but which have the TOD or transfer on death designation. All those accounts, they have nothing to do with what's written in the will. What's written as beneficiary designation, that becomes the main way in which it is passed on, or that has become the person to which it goes to. So I had this particular case where there was a lady, and she had her life insurance, her husband's life insurance policy. They'd just gotten married. They had got their legal documents done 2 years ago. The husband's life insurance policy, which was purchased before marriage, that had his mother's name as the beneficiary. And unfortunately, she did not get along very well with her mother-in-law at the time of the wedding, because the wedding was against the wishes of the boy's parents. So, but when he passed away, at that time, because the beneficiary designation had not been changed, all the money went to the mother and did not come to her. So beneficiary designated, this is what I mean by beneficiary designated asset. The second category of asset is those which pass by deed. Like, say for example, the home. We see in most cases the home is titled as, say Lalitji, your home would be titled, I'm just giving as an example, with Mr. Abichandani along with his spouse, Mrs. Abichandani, along with, So in that way, when it is husband and wife, then it is stated in two ways, either joint with the right of survivorship or tenants in entirety. These are legal terms, but what it means in both those cases, when one passes away, the other person automatically becomes the 100% owner. That is passing by deed. So that's the second category of asset. In that we see homes, we see joint investment accounts. Those are some of the popularly seen accounts that goes in that way. And then after that, what remains, that flows through the will. That could be business ownerships, individually owned accounts, or individually owned real estate. Those are normally, those pass through the will. So as you can see, if you're just focusing on the wills, healthcare proxy and power of attorney, sometimes a very large part of a person's estate, or what he owns or what needs to be done in estate planning, that remains outside and is not taken care of properly. So when we're looking at estate planning, we need to take a holistic view of this whole area.
Yeah, I think more often the life insurances, or in some cases the IRAs, they have this beneficiary designation, and that you're telling us that that supersedes the will.
Yes.
So people have to be very careful when and review these beneficiary forms every so often. I'm not saying every day, but every 2-3 years they should look into that and refresh that.
That's correct.
Right. Okay.
That is correct.
Okay. Also, what you're telling me that as far as inheritance goes, most people will have assets owned in the first or the second category. So they will be out of the will. Is that correct then?
Yes.
Yeah.
So just to come back to what we were talking about, Lalitji, that let's say that we meet a young couple, and this is a case which I was dealing with recently, and met with them. They had 401k plans, husband and wife, married for about 2 years. They had 401k plans. They just purchased their first home in their joint name. They had a mortgage on that home. Now, in that particular case, if say one of them passed away, then whatever they owned, other than a few personal belongings like the wife's jewelry or the husband's watches, couple of watches that he owned, other than that, everything would flow through either beneficiary designation or would flow through to the wife or to the husband, whoever was surviving, based on the deed. So the wills became less important. I'm not saying that they did not have to do that, but what I'm trying to say is that we need to take the overall picture into consideration, and estate planning therefore goes more than just the wills documents, which is what, Lalitji, exactly what you were trying to say a few minutes earlier.
Yeah.
You know.
Most people have that understanding of will, but they don't know the importance of these other documents as well. So will is just one of the components amongst other vehicles that we use, or other options that you have.
That's correct.
But beyond wills, and what I have seen is people are worried about estate tax. So tell us a little bit more about estate tax. When does that get applied?
Right. So let me relate this to, let's say to any business. In a business, we have two financial documents that you as a CPA would prepare for anybody. First would be what we call the income and expense statement, and then the balance sheet. Now, in a person's personal life also, there is the income and expense statement, which you normally prepare at the end of the year on the tax return. And then after that, whatever is the owned by a person, which we call the net worth statement, is what he owns. All your life, you're taxed on your income and expense statement. While when you pass away and things flow to the next generation or to anybody other than a US citizen spouse, then there is a tax to be paid, and that's called estate taxes. So we're here talking about all the assets. What do we include in all the assets? Everything. Say a home. So if it's a home that is jointly owned by husband and wife, then half is counted as the husband's property, half is counted as the wife's property. When they pass away, half is taken into account. Then we take all the IRA accounts, we take all the investment account, and we add everything together and create a net worth statement. And based on the net worth statement, it is to be determined whether that person needs to pay estate taxes or not. Now, fortunately, in 2012, the limit for paying estate taxes was raised considerably. And today, when a person passes away and he leaves money to the next generation, anything he leaves above $5.45 million, that means $5,450,000, that today for 2016, that amount would be above that amount would have to pay estate taxes. So if we take the case of a husband and the wife together, then the exemption or the amount that they can pass on to their children is approximately $11 million. So you will see that that itself eliminates a lot of people who do not have to pay any estate taxes. But let us say someone has worked all their life and created assets and today has about 20 million, husband and wife together. That means that 11 million is exempt. The amount above that, which is $9 million, on the passing away of the second of the couple, that means the second death, that means let's say in this case, let's say the husband passes away, a year later the wife passes away. So when the wife passes away, when that 20 million moves to the next generation, 9 million out of that is subject to 40% estate tax from federal government. That means that they have to pay 3.6 million. Certain states also have estate taxes. I've not taken that into account here. So you have to add the federal tax and the state tax and pay that accordingly. So that.
But the state tax generally have a different limitation than 5.45.
That is correct.
Yes.
You're absolutely right. Like New York has a different limitation, which is now a little over $3 million, $3.5 million,
Yes.
and for 2016, and that's also going to go up, to equal the federal state
Correct.
exemption.
That looks like a lot, but that's what it is. And in about a week we have election, and if Hillary comes in, she's now talking about raising it to 65%, the 40% that you say, which is really punitive.
Right.
So give us some ways out that what can people do to safeguard themselves and from this 65% threshold that she's talking about.
Absolutely. Let's see, but before we talk about punitive, let us talk about the gift that is there inside the estate tax law. So let us say, for example, that if I pass away, okay, and I leave everything to my son, and that includes, let's say, some stocks which I purchased at $100,000 and which are valued at $200,000 today. Immediately after I pass away, my son sells those stocks and he gets $200,000. There's something called step up in basis. That means for him, the cost basis, that is the cost at which he sold that stock, is 200 the value on the day I passed away. Now that helps the next generation save substantial capital gains taxes. So with that in mind, that is a gift inside. So we use that, plus we use a lot of other strategies to help people save. As I said, we do lifetime planning, and within the lifetime planning circle, we will complete all of these parts. Lalit.
So the basic idea is that we have to be aware of these laws and what potential problem there is, and come together and start accumulating your details so that we can look at it and we can do this estate planning.
Absolutely.
And if whatever measures are required, we can take those, whether it is taking additional insurances to protect that fire sale that you talked about. So Pareshji, this is really a long topic. We'll come back on this again one more time.
Sure.
We are short of time this time. So viewers, thank you very much for watching this. Like I said, estate planning is a very important issue because some states have very low threshold on passing the amount. So having said that, it is important, even if the amounts are smaller, it's important to get the details together and go to a professional and talk about this so that you are not caught off guard. Thanks again for viewing, for watching this, and Paresh ji, thank you very much for the valuable information.
Thank you, Lalit ji.
Thank you.
Always a pleasure.
See you next time.